Good morning. I'm Jane Miller with the Illinois Department of Revenue Sales Tax area. Well, I'm in the taxpayer assistance, and we have quite a few changes this year, and most of them are accompanied by the year-end bulletins. So the first one is the Illinois sales tax treatment of point-of-sale transfer of federal clean vehicle tax credits, and that's fiscal year bulletin 2024-19. So the federal government provides purchasers a federal income tax credit for the purchase of clean or electric vehicles. Purchasers are authorized to transfer the federal income tax credit to the vehicle dealer at the time of purchasing a clean or electric vehicle in exchange for a payment from the vehicle dealer. This payment may be made either as a cash payment to the purchaser or as a payment applied to the purchase price of the vehicle. If the payment is applied to the purchase price of the vehicle, it is then included as taxable consideration for the sale of the vehicle. So when the federal clean vehicle tax credit is transferred to the dealership and used as a down payment on a vehicle, the tax is due on the total price of the vehicle, including the credit amount. So effective January 1st, 2024, the federal clean vehicle tax credit may be used as a down payment or as part of the taxable selling price of the vehicle. The dealer must show proof the payment was made to the purchaser in cash or as a down payment in the amount equal to the allowable credit. This is similar to manufacturer rebates or manufacturer reimbursed coupons. Like any third-party payment to a retailer, if the federal clean vehicle income tax credit is applied to the purchase of a clean vehicle, it must be included in gross receipts and is fully taxable under retailer's occupation tax. Okay, the next fiscal year bulletin we're going to talk about is FY 2024-27. And this is about the rate change for the out-of-state depreciation on motor vehicle use tax, and this was effective July 1st, 2024. So on the vehicle tax returns, the RUT-25 and the RUT-25 LSE, the monthly depreciation rate for vehicles used out of state for more than 1 month changed to 1.67% effective July 1st, 2024. Until June 30th, 2024, the monthly vehicle depreciation rate was 2%. According to the Illinois Use Tax Act, taxpayers may claim a reasonable allowance for depreciation for out-of-state use on vehicles that are purchased from a retailer, acquired and used outside of Illinois when the taxpayer was a resident of another state and then brought into Illinois to be titled and registered here. Currently, the presumed average life expectancy of such motor vehicles is 60 months, and the depreciation rate is the 1.67% or 0.0167 for each whole month the vehicle was previously used out of state. The depreciation is calculated by taking the number of whole months the item was used out of state. So for example, August 28, 2024 to September 28, 2024, that would equal 1 whole month, and multiplying the applicable depreciation rate. 1 month of depreciation would equal a deduction in the vehicle's taxable value by 1.67%. Okay, the next fiscal year bulletin we have to talk about is FY 2025-03. And this is relief for filers of Form ST556 and the ST556 LSE on the computerized vehicle registration outage. There was a CVR outage last summer, and it caused many of the ST556s to be filed late. So the Department of Revenue is granting relief for taxpayers impacted by the outage of CVR, impacting the ST556 and the ST556 LSE forms that were due between June 19th, 2024 through July 16th, 2024. Electronically filed returns must have been submitted by August 5th, 2024, and the paper returns must say CVR outage at the top of the return to request relief. That's okay. Okay, we need to, next slide, please. And what we should be on slide 109. Maximum allowable discount. Mhm. Yes, yes, 109, please. Okay, this is, yes, fiscal year 2025-04, the retailer's discount for certain tax returns capped at $1,000 per month. So remitters of sales tax in Illinois are granted a 1.75% discount for filing and paying on time. And I've lost the slide, but yes, yes. But effective for returns due on or after January 1st, 2025, for sales and use tax returns and other related returns, Public Act 103-592 reduces the maximum allowable discount that can be claimed by a taxpayer to $1,000 per month. If the taxpayer claims more of a discount than is allowed, the taxpayer will be liable for penalties and interest on the difference. If filing on my tax, the discount will automatically be calculated. So we should be on 111, please. That's okay. For the ST556 and the ST556 LSE, and also the LSE1, the discount line will no longer be on the return effective December 12th, 2024, because those are returns that would be due in 2025. The taxpayer will receive a refund check of $1,000 of the $1,000 discount after the transaction returns for the month have been processed. Okay, here are some examples. The ST1 has $100,000 in tax due. The calculated discount is $1,750, which would now be limited to $1,000. And then we also have the municipal motor fuel tax return, the MMFT1. Tax due is $70,000. The discount rate is still that 1.75%. The calculated discount is $1,225. The maximum discount allowed is $1,000. So the discount allowed to be claimed would be limited to $1,000. Okay, the next fiscal year bulletin we're going to talk about is FY 2024-12. And this is changes to parking excise tax booking intermediaries, their obligation to collect and remit the tax. Effective January 1st, 2024, entities working as booking intermediaries for parking operators must register with the Illinois Department of Revenue to collect and remit the parking excise tax. A third-party company which books and collects money for parking spaces is now required to collect and remit parking excise taxes to the Illinois Department of Revenue. And the reason I brought that up is because that is similar to a new fiscal year bulletin we have out. And this is the hotel operators occupation tax updates for operators and re-renters of hotel rooms. And this is fiscal year bulletin 2024-29. So once the leveling the playing field threshold is met, re-renters of hotel rooms must register for hotel operators occupation tax and must file form RHM1. The RHM7 is filed for multiple sites. Re-renters of hotel rooms are authorized to facilitate bookings and grant occupancy of hotel rooms located in Illinois. Some examples of the re-renters of hotel rooms are Priceline.com, Hotels.com, Cheap Hotels, Booking.com, and Trivago. The re-renters of hotel rooms apply the tax rates based on the location of the hotel, which is considered to be a destination-based tax rate. Hotel operators should not claim rentals made to re-renters as exempt. Hotel re-renters owe tax on the entire charge to a guest for the rental of a hotel room, including any fees or commissions received. Okay. The hotel re-renters may claim a deduction for the cost of the room and any taxes paid to a hotel operator for the initial rental of the hotel room on line 4 of Form RHM1, the hotel operator's occupation tax return. To claim the deduction, the re-renter must enter the description as re-renter deduction and deduct the amount paid to the hotel operator for re-rental of hotel rooms, including tax paid. Multiple locations would use the form RHM-7. The re-renters of hotel rooms and hotel operators should each retain all receipts showing hotel names, locations, rental fees, taxes paid to hotel operators, fees for re-renting the hotel rooms, and any deductions claimed. Identify multiple deductions by type and amount. The re-renter, or to review, re-renters are authorized to grant occupancy of hotel rooms to in Illinois to guests of the hotel. They can facilitate bookings of a hotel room located in Illinois. And once the leveling the playing field threshold is met, re-renters must register for hotel operators occupation tax and must file Form RHM1. If there are multiple sites, they must use the RHM-7. Okay, next we have a compliance alert. And these are sales that are made to Medicare administrative contractors. And this compliance alert was effective June 2024. So the compliance problem, and we still haven't caught up, the compliance problem is that Medicare administrative contractors are private entities that have contracted with the United States government to process Medicare Part A and B claims for Medicare and Medicaid services. The MACs are private entities contracting with the United States government to process Medicare Part A and Part B claims. After processing the claims, the MACs remit payment to the retailer for tangible personal property provided to the Medicare beneficiaries. These transactions are not exempt from Illinois sales tax, as they are sales to a private contractor, not sales made directly to the U.S. government. Okay, they're not exempt. I'm sorry. Now we're going to move on to the new exemption for certain home delivered meals purchased on behalf of Medicare or Medicaid recipients. So this is Fiscal Year Bulletin 2025-06. And it's the new sales tax exemption for qualified purchases of home delivered meals effective July 1st, 2024. When payment is made by an intermediary, such as a Medicare administrative contractor, a managed care organization, or a Medicare Advantage organization, pursuant to a government contract, purchases of home delivered meals provided to Medicare or Medicaid recipients are exempt from ROT or retailer's occupation tax, service occupation tax, use tax, and service use tax. The purchasers must certify that home delivered meals are purchased on behalf of Medicare or Medicaid recipients as an intermediary pursuant to a government contract, and they must properly document this certification using Form ST-591, Certificate of Exemption Eligibility for Qualified Purchase of Home Delivered Meals. Form ST-591 should be given to the retailer. This exemption must be claimed as a deduction on Form ST1, the sales and use tax and E911 surcharge return. It should be included in receipts for sales of these products in Step 2, Line 1 of the Form ST1. Then include these receipts in your total deductions on Step 2, Line 2. When calculating your total deductions, report these receipts on line 16 of Schedule A with an appropriate description. Okay, now we have a new bulletin. It's Retailer's Occupation Tax Guidance for Out-of-State Sellers and Certain Illinois Retailers effective January 1st, 2025. So effective January 1st, 2025, Public Act 103-983 amends the Retailer's Occupation Act to require that all retail sales sourced outside of Illinois and made to Illinois customers by retailers with nexus to Illinois are subject to destination-based retailer's occupation tax. This change affects out-of-state sellers headquartered outside of Illinois but with a physical presence in Illinois who make sales to Illinois customers that are sourced outside of Illinois, and to Illinois retailers headquartered in Illinois who make sales to Illinois customers that are sourced outside of Illinois. For these types of sales, tax must be collected at the destination rate in effect at the time of the sale. Destination-based rate means the total state and local retailer's occupation tax rate calculated for a sale using the rate in effective at the Illinois location to which the tangible personal property is shipped or delivered, or at which possession is taken by the purchaser. Okay, we also have a new bulletin that is not out yet, but it will be out soon. And it's the Illinois sales and use tax applies to leased or rented tangible personal property. So effective January 1st, 2025, Public Act 103-592 amends the Retailer's Occupation Tax Act, the Use Tax Act, and the Service Occupation Tax Act, and the Service Use Tax Act to make lease transactions subject to Illinois sales and use tax laws. This provides that lease of a tangible personal property is considered sale at retail. You must register as a retailer with the Illinois Department of Revenue if, in the ordinary course of your business, you regularly lease, offer to lease, or arrange for the leasing of merchandise in Illinois. Rentals and leases of tangible personal property are all subject to the provision of Public Act 103-592. On and after January 1st, 2025, the term sale, as used in retailer's occupation tax, also includes leases. For the purposes of the amendments of Public Act 103-592, a lease does not include transactions for motor vehicles, watercraft, aircraft, and semi-trailers that are required to be registered with an agency of the state of Illinois. The difference between a lease and a rental purchase agreement lease. A lease transaction generally does not permit the consumer to become the owner of the merchandise. A lease as a transfer of possession or control of, the right to possess or control, or license to use but not title to, tangible personal property for a fixed or indeterminate term for consideration regardless of the name by which the transaction is called. So no merchandise changes hands at the end of the lease. A rental purchase agreement is an agreement for the use of merchandise by a consumer for personal, family, or household purposes for an initial period of 4 months or less that is automatically renewable with each payment after the initial period that permits the consumer to become the owner of the merchandise. So what receipts from a rental or lease transaction are subject to tax? The lessor must remit for each tax return period only the tax applicable to that part of the selling price actually received during such tax return period. Selling price with regard to rental or lease is the same as with a retail sale. The consideration for a sale valued in money, whether received in money or otherwise, including cash, credits, property, and services. The next slide deals with Are existing contracts for lease or rentals entered into prior to January 1st, 2025 subject to the tax? Yes. The tax is imposed on all gross receipts received under a lease or rental contract on or after January 1st, 2025. While the tax does not apply to any of these receipts received before January 1st, 2025, any amounts received on or after January 1st, 2025 are subject to the tax, including amounts received on contracts with current customers that were in place before January 1st, 2025. So are leases and rentals of computer software subject to the tax? In most cases, leases and rentals of computer software are not subject to the leasing tax if it meets the following requirements. The lease or rental is evident by a written agreement signed by the licensor and the customer. The written agreement must restrict the customer's duplication and use of the software. The licensor must have a policy of providing another copy at minimal or no charge if the customer loses or damages the software, or of permitting the licensee to make and keep an archival copy, and this policy must either be stated in the license agreement, be supported by the licensor's books and records, or be supported by a notarized statement made under the penalties of perjury by the licensor. Okay. It is not taxable if the written agreement prohibits the customer from licensing, sublicensing, or transferring the software to a third party without the permission and continued control of the licensor. If the licensor has a policy of providing another copy at minimal or no charge if the customer loses or damages the software. If the customer is required to destroy or return all copies of the software to the licensor at the end of the licensing period. For leases or rentals of most tangible personal property, how do I pay the tax due? Receipts from most leases or rentals of items of tangible personal property are reported on Form ST1 Sales and Use Tax and E911 Surcharge Return. Use MyTax Illinois, available at mytax.illinois.gov.